In today's video, we are going to take a look at a situation where an individual started a whole life insurance policy. High cash value was their goal. And originally they started their policy with the goal of funding it for 10 years at $30,000 per year. However, 1 year into the policy, they changed their mind. They looked at it and said, you know what? I've got a lot of things going on. I'm not sure that I want to fund this policy at $30,000 per year. What would it look like if I go a different route? Specifically, if I fund different amounts. What does it look like if I only fund the minimum? What does it look like if I stop funding altogether? They wanted to see options. So we're going to look at just that today. So let's get on into it and have some fun. What we'll begin with is the basic details. We've got a 39-year-old female. She had received the top health class rating, a preferred plus rating. We also have a 1035 exchange. So a 1035 exchange, if you're not familiar with this term, this is a transfer of cash value from one life insurance policy to another. It can be very advantageous at times, and there's also times where it does not make sense at all. This is something we really like to analyze. In her particular case, a 1035 exchange made a lot of sense because what she had noticed with her existing policy before starting this one is that she was losing money. And typically where you see an individual losing money with a cash value life insurance policy is in a universal life type product, specifically where the insurance expenses are exceeding the earnings rate. So she looked at it, she wasn't happy. We looked at a new policy, looked at the 1035 exchange. It made a lot of sense. And what really made it look good is that we have a large first year PUA payment. We're going to go through the exact numbers, but you're going to see a minimum premium of a little bit over $3,000, and the 1035 exchange amount was just over $180,000. So that is a huge first year cash infusion, which put her in a really good position where she can elect to stop paying into the policy altogether very early if she wants to. We're going to see that. So the original plan, she wanted to fund the policy for 10 years. However, she changed her mind. And she doesn't necessarily want to stop altogether, but wants to see some different options. Particularly, what does it look like if I stop paying? What does it look like if I pay just the minimum? And what does it look like if I do elect to continue to fund it at $30,000 per year? So if you're in a situation where you're undecided, or you're thinking, okay, I think I can still pay $30K per year, but I'm just not sure, what does it look like if I pay a different dollar amount? Regardless of the actual funding that applies to your policy, seeing different options before starting a policy and even after looking at in-force illustrations is very, very beneficial. I'm a huge fan of that because I can see the what-if scenarios. What do things look like if I pivot after I've already started a policy? Now, here's something very important. Let's underline this in red. Review the numbers, specifically look at the guarantees. So important to look at the guaranteed values in a policy, especially when I'm making adjustments. If we were to look at the guarantees based on a scenario where I'm funding $30,000 per year, this policy is set up with a base premium of a little bit higher than $3,000. And then shoving money into PUAs, we've got a term rider attached to prevent a MEC from occurring. And then this huge 1035 exchange, you're going to see of $180,000, more than that, paid right into our PUA rider out of the gates. So if I look at the guarantees with $30K per year going in and this large 1035 exchange, it's going to look fantastic. However, if I elect not to add more funds into PUAs, that will impact the performance. And typically where you will see a greater impact, if this is you, is based on the guarantees. They will not look quite as attractive. And if you're buying something or if you have a product, do you feel that it's beneficial to see the areas that don't look as attractive, meaning show me the worst case scenario, let me at least be aware of it? Yes, it's extremely important. And I mention this because in this industry, when you're working with your agent, sometimes you will have to request this information. And then lastly here, she does plan on using her policy for real estate. She's heavily involved in real estate. So we're going to look at an example of how she can do that too. So let's take a look here. What we'll look at first are these options based on the present dividend interest rate. And then we'll look at the same scenarios, but based on the guarantees. So what we've got here, on the left, stop funding, middle, pay the minimum only, and then to the right, $30,000 per year for 10 years, which is the original plan, or very, very close to what she originally considered. So again, this is based on the present dividend interest rate. We see that in blue up top under dividend values. So with this guy, what do we see here? Annual outlay, $43.21. Now we mentioned that the base premium is a little over $3,000, and it is. Why we see $43.21 here is because we do have a very large term insurance rider attached to the policy. So everything above that base premium is covering the term rider, and then we round it up so a little bit is still going to a scheduled PUA payment. But base premiums a bit over $3K, and the rest covers the term. That's where we came up with that bit of an oddball number, $4,300 and change. Here's what she paid in the first year, $43.21, and then had this 1035 exchange of $181 and change, almost $182. So we've got total payments, $186, and this does account for the rollover too, the 1035 exchange. So that's the total money that went into her policy. And then what's her cash value in the first year? $179. So over here, we've got net cash value, and let me just make a quick tweak here so we can see all of the wording in here. Net cash value growth, that's very important there. Negative $6,800. So it's negative $6,840 because $186 went in, and she has less than that, $179 and change. Death benefit, $2.5 million. Now that $2.5 million in total life insurance gives her a MEC limit greater than $30,000. Quick side note, 1035 exchange dollars do not count against your MEC limit. When you initially design a policy, a 1035 exchange will have an impact on the MEC limit, meaning if I look at a policy with a $2 million death benefit with and without a 1035 exchange, I'll see different MEC limits. I know that can be confusing. However, to get back on track here, this 181 does not go against the MEC limit, meaning I do not need a MEC limit of $181,000 to accommodate this. If my plan is to pay in a maximum of, call it $30,000 per year, I only need a MEC limit of $30,000. And the policy can still accept that large 1035 exchange without triggering a MEC. Pretty cool, right? So the MEC limit is a bit higher than 30K in this example, mainly so it can accommodate payments of 30K per year for 10 years. But as we look at this guy, what do you notice? Year 2, she pays nothing in. Out of pocket is 0. What do you notice here with the death benefit? We dropped it. What we did in this particular case is remove the term insurance rider. So typically you cannot reduce the death benefit during the first 7 years because what happens is it reduces the MEC limit. However, if you have not funded up to the MEC limit, so here we've never funded $30,000. So what that allows us to do is drop the death benefit, which does drop the MEC limit. However, the MEC limit is still well above $43.21, which was the most we've ever paid into the policy. So in summary, it prevents a MEC from occurring. And this is something you can easily forecast before making a change like this. But my point is, we're able to drop the death benefit because we have not heavily funded it. If we did something like this, 30K per year, and then drop the death benefit in the first 7 years, that would be a situation where we will likely see a MEC occur. But in this case, we did not. So if she says, with certainty, I want to stop funding altogether, Steve. I don't want to add anything else into the policy after reviewing the options. Reducing the death benefit earlier, granted it does not trigger a MEC, allows us to reduce the expenses, which allows the cash value to grow at a faster pace. This is the kind of stuff we want to be aware of with respect to the insurance company and product we're working with, what changes can be made. So what this does, and this is so sweet when we look at it, a break-even point of year 2, and that is because of the large 1035 exchange. There is still a premium due through the 7th year in this example. However, the policy is paying for itself through dividends and interest. And then in year 8, you'll see another drop in death benefit. And that's because we killed the premium through a reduced paid up option. And if you're working with us in a case like this, we're going to be providing the actual illustrations from the insurance carrier as well and talking through those, especially if you have questions, because that provides all of the details that are important to look at. But this is a summary report. Look at that. Cash value growth. Looks good. Just for a safe area to position money, cash value continues to appreciate. She said, the death benefit is not a huge concern. I'm really interested in the cash value. She's got other assets. She even views herself as somewhat self-insured. She's done well. But still, she's got a healthy death benefit. In a worst case scenario, she's always very close to $1 million. It bottoms out at about $900K. Now, that's a worst case scenario based on the present dividend values. We're going to look at that based on the guarantees too. But let's take a look at this. What's it look like if you elect to continue to make payments? Specifically, if you only pay the minimum, which we can pay less than this, but I just paid or illustrated the minimum at the same dollar amount she actually paid in the first year. So when we look at this, here's our payments, break even, still in year 2, fantastic. And here's your net cash value growth. Now sometimes what pops up here, and she actually asked this question, she said, why is it in the second year, when I add money to the policy, the net growth is less than the example where I don't add money to the policy? Shouldn't it be the opposite? Yes, it should be, but it's not. The reason why is when we make payments, we've got premium loads. We still have a term rider attached in this example. The example to the left, we cut the term rider. We're adding a small amount in this example to PUAs. There are PUA fees associated with products. And we've got other videos that provide breakdowns on all of this, but my point is, when we're making payments, a small amount is going to go to the insurance company, which is why when we isolate this year, what do we see? A little bit less in growth compared to the example where we don't pay it. And that lasts for a couple more years, or more than a couple, but not too long. What happens eventually? The example where we've pumped more money in will grow at a faster pace, and that will be especially true after the 10th year, where we have removed the term rider and killed the premium altogether. Very easy stuff to follow. No, I know some of it can be complex. Then the example to the far right, the original plan, what it looks like if she funds $30K per year. Now, before we look at the guarantees, here's what we settled on, or what we recommended here, is she looked at it and says, okay, I see the numbers. It makes sense for me to continue to make payments. If I throw $30K in, I see what I'll have in cash value. That's great. Do I have to add it all up front? No, you don't. Here's what you can do. If there's a chance you still want to be able to add up to $30K per year, or be able to add more money into PUAs, what I would recommend is paying at least the premium here. And then what you can do is add additional funds into PUAs on an unscheduled basis. And you can do that by just logging onto your online portal and sending funds directly in. Very, very flexible there. That allows you to commit to the minimum and throw money in anytime. And we can also model that for you anytime we'd like as well, before you make the payment, after you make the payment. This way you can see exactly what it looks like. Let's continue on and take a look at the guaranteed values. So here, we've got the exact same scenarios, but based on the guarantees, a worst case scenario. And when I say guaranteed values, this is going to assume two things. One, no dividends are paid, just the guaranteed rate. And then two, we've got a term insurance rider attached. This is going to assume that the company is going to charge the maximum allowable rate for the term insurance rider that the company can assess. So it really puts us in a worst case scenario. If you're one who likes to set expectations by looking at what's the worst possible case scenario, and if I'm comfortable with that after seeing it, then I can move forward knowing that it'll probably deliver more. These are good to look at then. So the 1035 exchange really helps these guaranteed values look fantastic. So here we go. First year, second year, no payments, not breaking even, but you're pretty close, which is why I have years 2 and 3 highlighted, because we're breaking even between years 2 and 3. In the example where we make payments, there's my total payments. Check that out, between years 2 and 3. And in the sample where we max fund it at $30K per year, look how close you are in year 2. On a guaranteed basis. It's pretty sweet, isn't it? Now, normally you will not see guaranteed values like this. This is an old product. She got it in right before the deadline, before that 7702 update occurred. So the guaranteed rate she has is 4%. If you look at the same product that now has a 3% guaranteed rate, in this case, the break-even point would be delayed a bit with this large 1035, likely between years 4 and 5. If you're in a situation where you don't have a 1035 exchange or a very high initial lump sum, typically the earliest we see a break-even point with this updated product is around year 6 or 7, assuming we elect a low PUA fee. We've got other videos that provide more detail on that. But my point is here, what's really, really nice about this, if we look at a worst case scenario, not only do you break even early, but we see the cash value continue to appreciate based on the guarantees. And what really helped in this situation was seeing all of this up front, because the literature in life insurance contracts and on online portals, and even sometimes when you speak with customer service reps at insurance carriers and what they tell us, it can be confusing and overwhelming. She had reason to believe, from what she had researched on her own, that her cash value was actually going down. She had thought that the dividends were not being applied to paid up additions and helping grow her cash value, but they were just buying more life insurance and satisfying the term insurance rider cost. And a reason for that is there's a million different terms for dividends and where they can be applied. However, what we like to do in a case like that is first talk through exactly how it works, but then provide numbers. If I flip positions with an individual who thinks that they were set up in a policy and it might be a bad deal, what would help me if I'm in their position is seeing something like this. Based on an absolute worst case scenario, my values continue to appreciate, and this is based off my actual policy values because I've already initiated it. And then I see, okay, the values keep going up. Why was I told this? Maybe it was just a misunderstanding, whatever, I know I'm good now. And then based on the present dividend rate, it appreciates even faster. Okay, so she got that, which is fantastic. The last thing we wanted to touch on was what? Using for real estate. So she is a real estate investor. So what we wanted to look at in this case was a workbook that allowed her to get a quick answer of what loans would potentially look like. And she asked, why do people do this? Like, what's the point of attraction? And my answer was, when you look at real estate investors who do this, because that's what she is, one, they look at it as an area to position cash. It's a safe area to position funds. The net internal rate of return will fall somewhere between 3 to 5%. Safe area. You've got tax benefits as well. That's very attractive. And then it's liquid. You can access your cash value very similar to a line of credit. And if you have $200,000 in cash value, similar to what she has, and you elect to borrow half of that, $100,000, you'll find that dividends continue to accrue on your full $200,000. There's no lost opportunity cost. Oh, okay. So I can use this similar to a line of credit. Yes, that's what you'll see a lot of people do. And the life insurance benefit helps a lot of real estate investors too. In the event that something happens when I have loans outstanding, if I've got mortgage notes outstanding, that death benefit can certainly help in that particular case. That's valuable to some people it's not, but I do like mentioning it. So in this case, what we've got is as follows. The sample, where we've got $30K per year going in. Here's the cash values. Here's our annual internal rate of return. So she can see the growth rate. Here's the yearly cash value growth and the total gain on cash value. So what we like to look at here is on the yearly cash value growth, compare this to annual interest paid, and then the total gains on cash value, compare it to total interest paid. So in this example, let's look at a $200,000 loan. There's a $200K loan. Loan interest is 5.66%. When we take a loan, that death benefit will be collateralized dollar for dollar. Anytime you're looking at loan models, I would always encourage you to look at an actual illustration so you can see the exact impact from the insurance company on their literature. It's very important. We've also got videos that demonstrate that, but that's important to look at just from a transparency standpoint. So a $200,000 loan is taken. There's my loan balance. Here's the loan interest. So each year I pay loan interest, and here's what I want to look at. What am I paying in loan interest compared to what is my policy growing by? That's the question. And here, if we take a loan out in year 2, if it's $200K, I'm paying more in loan interest than what I'm earning from the insurance policy. If it is a $100,000 loan, what happens? Bit of a different story. I'm paying $5,660, and the growth was $7,800 and change. So this is a nice workbook because I can plug in different numbers and see exactly when I'm in the black and when I'm in the red on a yearly basis. It's 150, I'm very close. Let's go back to 200. So I'm in the red for a couple years. Why don't we do this actually? Let's take out a couple loans here. So available equity shows the max we can take. And we'll pay just interest. So we'll see this sometimes where individuals will fund a policy. They'll take loans, they'll pay interest on that outstanding loan, and then when they are no longer funding the policy, they'll begin to redirect funding toward principal payments. That's not always the most efficient way to do it. There are times where I'll look at the numbers and say, hey, as we analyze everything, it might make sense to kick your funding down a bit and redirect some of those PUA payments toward loan principal payments in order to push the interest that's going to be due each year down. As we just look at the overall net gains on the policy versus net cost, sometimes that makes more sense. But looking at this, so we took loans, total of $550,000. And what we're going to do here, beginning year 11, repay it. Every single year, we're paying loan interest. By the 10th year, I've paid $155,000 in loan interest. I've gained $124,000. So if you're going to take maximum loans, and we can tell here we've taken close to the maximum because my available equity is not that much. I've got most of my cash value outstanding in loans. If I'm taking maximum loans and my interest rate is higher than my internal rate of return, I'm going to see a position where I'm upside down. What I mean when I say that, I've paid more interest than what the policy has produced in gains. However, if you are applying principal payments or not taking maximum loans, we can work it out so we're not in the red, but I like to see that stuff up front. Let's start to repay it here at, why don't we do 50 per year? You can pay it back however she wants, but a nice round number. So her out of pocket is actually more than 50K per year because she's paying the 50K plus the loan interest each year. This is a nice exercise here because if it's me, I'm really interested in this. Both columns to the far right. Total interest paid, total gains. Sweet. I also want to see when this makes sense. In this particular example, year 11, you're close, year 12, where the growth is greater than what I've paid. And let's do this. Yearly cash value growth. Important to see that. But just a model that we can put together, or we do put together for folks we work with so we can see everything side by side. So I hope you enjoyed this video. This was a fun case study. The 1035 exchange really helped out in a lot of ways. If you're in a situation where you don't have a 1035 exchange, it is possible to fund a policy with a lump sum. It might make sense to spread it out, but you can somewhat mimic what we see there. It'll just take a couple more years. But in any event, if you did enjoy this video, please hit the like button, subscribe for more. If you have any questions or comments, leave them below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.